It's Thursday, 9th of July, 2026. Welcome back to your news update on blip brief, crisp, but almost everything updated every market trading day.
We are jumping straight into the biggest macro driver of the last 24 hours.
hmm
It is a severe and sudden geopolitical shockwave out of the Middle East.
Yeah, and based on the previous day's closings, it is already sending violent ripples through Indian markets. U.S. President Donald Trump has unequivocally declared the Gulf War ceasefire over.
Right, and we are seeing fresh American military strikes launched against Iran. Crucially, Washington has revoked a 60-day waiver on Iranian energy supplies.
The immediate operational reality on the ground is, well, it's highly volatile right now. We have confirmation of missile alerts sounding across Bahrain and Qatar.
But when you analyze the market reaction, the panic isn't broad. It is singularly focused on one geographic choke point.
The Strait of Hormuz.
Exactly, that incredibly narrow waterway connecting the Persian Gulf to the open ocean. A massive percentage of the world's daily oil consumption passes through that specific corridor.
And the sheer threat of it being choked off is exactly what triggered the violent repricing we saw. And that repricing was immediate and brutal.
Yeah, looking at the numbers, and we're keeping strictly to percentage movements here, global crude oil spiked by over 6% in a matter of hours.
Wow. Over 6%.
Right, and that oil surge acted as a direct hammer on Indian equities at the previous close. The BSE Sensex tumbled by a sharp minus 2.15%.
And the Nifty 50 dropped by minus 2.12%. But the currency markets, they took an even harder hit.
They did. The Indian rupee logged its steepest monthly percentage decline. That officially makes it the worst performing currency on the Asian continent right now.
The fear is obviously that higher oil prices threaten to massively inflate India's import bill. But I have to push back on this timeline a bit.
Sure.
If the Strait of Hormuz is the world's oil jugular, how quickly does a percentage spike in crude actually bleed into the real Indian economy? Are we pricing in a phantom menace here, or is the pain immediate?
Well, remaining strictly neutral on the politics of the U.S.-Iran conflict here, the physical bleed certainly takes time, but the financial bleed is instantaneous.
Instantaneous. Why?
Because India imports the vast majority of its crude requirements. The moment crude spikes by over 6%, the forward contracts, which is refiners locking in prices for future delivery, they adjust upward immediately.
Right.
The hedging costs for Indian refiners spike. You don't have to wait for the physical barrels of oil to arrive at a port in Gujarat to actually feel the pain.
Because the markets look forward, not backward.
Exactly. The currency markets anticipate the widened current account deficit.
Yeah.
Basically, they calculate the growing gap between what we spend on imports versus what we earn on exports.
So traders know India is going to need to sell more rupees to buy more dollars just to afford that expensive oil.
That is exactly why the rupee depreciated so aggressively yesterday.
And for you, listening right now, a weaker rupee means every single imported commodity, not just oil, but your electronics, your machinery, instantly becomes more expensive. It injects imported inflation directly into the domestic system.
Which brings us to a massive contradiction in how global markets reacted.
Yeah, this is fascinating. We just outlined a textbook geopolitical crisis and a severe inflationary panic. Normally, that translates to a massive flight to safety, right?
Right, specifically a rush to buy gold.
But the exact opposite happened in the precious metals market. Gold actually dropped by minus 1.38%, and silver tanked by minus 2.78%.
It feels completely counterintuitive.
It does. Usually gold is the ultimate geopolitical panic room, but right now the US dollar is acting like a financial wrecking ball, hitting both our currency and precious metals simultaneously.
A wrecking ball is exactly right. It's a paradox, but it perfectly illustrates how deeply interconnected these capital flows really are. You see, the surge in oil is fueling massive inflation fears, but the markets are betting that this sudden spike will force the U.S. Federal Reserve to hike interest rates earlier than expected to cool down prices.
And when the expectation of higher interest rates sets in, U.S. Treasury yields shoot up.
Spot on. The yield on U.S. government debt goes up, which makes the U.S. dollar incredibly attractive to global capital. Here's the mechanism. Gold yields absolutely no interest.
It just sits there.
Exactly. So when the dollar and treasury yields surge, capital aggressively flows out of non-yielding safe havens like gold and rushes into the yielding safety of the U.S. dollar. That's why gold dropped during a war.
And that wrecking ball swung right through Wall Street as well. The Dow Jones dropped by minus 1.09%, and the Russell Index was down minus 0.8%. 8%.
But then you look at the tech-heavy NASDAQ, and it actually managed a plus 0.20% gain.
Right, buoyed almost entirely by a massive rally in AI chipmakers.
Well, the AI semiconductor space is currently operating on its own isolated macroeconomic island. The structural demand for the computational power required to train these large language models is just overwhelming.
So it completely overrides the broader geopolitical and interest rate anxieties.
Exactly. Capital is actively fleeing traditional industrials and taking shelter in the growth momentum of artificial intelligence infrastructure.
So, with capital fleeing traditional safe havens and searching for new advantages, let's pivot to a domestic irony playing out right here in India.
Let's hear it.
We have this heavy institutional sell-off and global panic, yet on the ground, retail investing optimism remains stubbornly high. I mean, India saw a massive percentage surge in new demat account additions in June.
That's the highest growth rate since February, actually.
Right, driven by incredibly aggressive digital onboarding and retail anticipation for IPOs. Retail is essentially buying the dip, but the stark contrast is what is happening on the institutional side.
Specifically to domestic proprietary trading firms.
Right. For those listening, prop trading firms trade their own money for direct market profit, and they're currently getting choked by new regulations from the Reserve Bank of India.
The RBI now demands a 100% collateral requirement for bank guarantees. This severely constrains liquidity for the domestic players.
And sharply increases their funding costs.
Let me put it this way. Imagine you're trying to buy a house, but instead of the standard down payment, the bank suddenly demands a 100% down payment in cash upfront.
Oh, wow.
It completely freezes your ability to invest your capital anywhere else. That is exactly what the RBI is doing to domestic prop traders right now.
And in high-frequency trading, capital efficiency is everything.
Right. If a domestic firm has to lock up 100% of their capital as collateral, their return on equity plummets.
So we have retail investors charging confidently through the front door while the RBI is essentially putting financial handcuffs on our domestic prop traders, handing the market advantage to foreign players.
Exactly. Firms like Jane Street and Citadel have ready access to significantly cheaper overseas capital.
So they can capture the arbitrage opportunities that domestic firms can no longer afford to execute.
It is a critical structural shift in the plumbing of Indian financial markets.
Well, let's follow that thread of structural shifts straight into corporate India, because companies are aggressively rewiring themselves for these headwinds. The IT sector is showing real signs of strain.
Yeah, Tata Consultancy Services is bracing for muted Q1 earnings, expecting a completely flat sequential revenue growth. We are talking about a 0% change.
The immediate issue for Heritage IT services is elongated client decision cycles, right?
Right. Global enterprises are scrutinizing every single dollar of tech spending due to the macro uncertainties we just discussed. But the more profound shift is generative AI.
We really need to pause on this because the human impact here is massive. We are witnessing what industry insiders are calling silent layoffs.
Yes, silent, because they aren't necessarily doing massive firing rounds. Instead, AI is actively taking the wheel on routine coding and testing.
So companies simply aren't hiring freshers.
Exactly. A significant percentage of the entry-level Indian IT workforce is quietly being phased out or absorbed through natural attrition this year.
It's a tale of two economies, really. Heritage IT is tightening its belt and replacing roles with AI, while fintech and foreign insurers are aggressively buying into the Indian growth story.
Look at PayU. They are aggressively targeting a 25% growth in both its total payment value and assets under management over the next 18 months.
And in the auto sector, Cardeco is preparing to file for an IPO this quarter. They are featuring both a fresh issue and an offer for sale.
And we are seeing that exact same foreign capital confidence play out in insurance. UK-based Aviva PLC is set to buy out the remaining 26% stake in its Indian joint venture.
This is a massive regulatory milestone. They will become the very first foreign insurer to fully own its Indian business under the newly liberalized government rules. Can you explain why this matters so much?
Absolutely. For decades, foreign direct investment caps forced foreign insurers to hold hands with a local domestic partner. They couldn't own the whole pie.
Right.
Now, Aviva buying out that final 26% signals incredible long-term confidence in the Indian consumer. They have absolute strategic control to go after 100% ownership.
Now, we have to pivot from corporate boardrooms to the ultimate force majeure that dictates the ground reality of the Indian economy, the monsoon,
Ah, yes. July brought a massive 42% surplus in rainfall.
which drastically narrowed the country's rainfall deficit down to just 24%.
From a purely macroeconomic standpoint, this is a massive boost. It heavily accelerates crop sowing across the agricultural belt.
And a healthy Kharif season directly translates to robust rural incomes.
Exactly. When rural India has money, they drive demand for everything. It essentially acts as a natural stimulus package for the broader economy. And, crucially, it helps keep domestic food inflation in check.
But the cost of that rural stimulus is absolute urban paralysis. The heavy rains have severely battered Delhi, Gurugram, and Mumbai.
It completely halted ground logistics and severely disrupted flight operations.
We even saw tragic building collapses in Pune. It's the ultimate Indian economic paradox. The exact same rain that saves our agricultural GDP completely paralyzes our financial capitals.
This exposes a severe deficit in urban resilience. To weather these future demands, India's power transmission sector is projecting a massive percentage increase in capital expenditure by FY32.
Because you can't just plug gigawatts of new solar power into a grid that shorts out every time it rains in Gurugram.
Right. The focus is shifting to ensuring the transmission infrastructure can actually withstand extreme weather.
Speaking of complex infrastructure, for our innovation deep dive today, we are shifting the focus from terrestrial weather to orbital environments. Skyroot Aerospace's Vikram 1 orbital flight is coming up.
This is a critical development. Vikram 1 will carry Cosmos-Serve's debris removal demonstration. It's an active space debris removal system utilizing dual spacecraft technology.
Let's break down how that actually works. As low Earth orbit gets crowded, this tech acts like a cosmic tow truck.
Right. Basically, yes. It is designed to autonomously approach defunct satellites, physically capture them, and pull them down into lower orbits.
Here they safely burn up upon re-entering Earth's atmosphere. So we aren't just launching satellites anymore. Indian startups are building the garbage trucks required to keep Earth's orbit sustainable. That is a massive leap up the value chain.
It fundamentally moves the Indian space industry to offering highly specialized orbital maintenance solutions. Active debris removal is rapidly becoming a commercial necessity.
It leaves you with a profound question, though. As AI and autonomous systems advance, how long until these orbital tow trucks make their own decisions about which space debris to capture and who regulates the traffic cops of space?
It's a regulatory nightmare waiting to happen.
And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.